Great, thank you so much. Well, let me introduce our panel quickly here. We have Colin Morrison, who is the Director of Business Development and Venture Capital Investments at Boston Scientific. David Kereiakes, right, partner at Providence Ventures. Oliver Keown at Intuitive Ventures. And Cheng, Managing Director at Ascension Ventures. So today our panel, there's been this evolution of healthcare systems and strategic companies, not just being interested in M&A and consumers of innovation, but really taking on the role of investor, helping to develop and figure out what we're going to commercialize. So that's what we're going to talk about today. I'll start with the question to our two strategics. Obviously, you guys started with more M&A and business development and evolved into ventures. Can you tell us a little bit about that journey?
Happy to start. And so Oliver Keown, Managing Director at Intuitive Ventures, as Ashley said. Intuitive Surgical is my corporate parent, leader in the field of surgical robotics, a space that's not just medical device and equipment, it's digital ecosystem, it's training, it's services. So naturally in a broader field that requires partnership and working with a whole range of stakeholders across healthcare. I actually joined at the time when it was, really directed towards a venture strategy, and the company and leadership at the time, and this was 4 years ago, didn't have a venture arm or a means to engage really with early stage companies other than the traditional business development, licensing, partnership, some M&A. When I joined, leadership were interested in venture capital. They were interested largely out of how do we engage in a sophisticated manner with early stage companies where they are independent of Intuitive, they're pushing the boundaries in a much broader fashion. They represent the future of the ecosystem that we're in and potentially also disruptive and transformative trends in the field. And they were very open to what best-in-class venture capital could do, corporate venture capital could do to achieve that. And so when I joined, it was really about using the best practices of corporate venture capital, working with leadership to put in place a structure that could engage with these companies so that we could be a meaningful participant in that ecosystem, but be very differentiated from business development in our goals and objectives. And I know we're going to discuss some of that over the panel today.
Yeah, absolutely. Colin, do you want to comment on that a little bit as well?
Yeah, sure. I think, first of all, Colin Morrison, Boston Scientific Ventures, great to be here this afternoon. I think this is going to be a great comparison because it's a great example of how two strategics approach venture from very different angles. By comparison, we're a pure strategic investor, so we are much more narrowly focused within the current existing strategies of Boston Scientific and the 6 divisions that are underneath that umbrella. We got into venture for very different reasons. We started, we'd call our current vintage in 2012. And the reason we really moved to venture is because at the time, as you can imagine, coming out of the financial crisis, there was just a need for capital to be able to be introduced to help companies develop and get to a point to where a strategic might want to acquire them. And so that is really how we started, and that's really been the DNA of our venture program for the last 11 years. Moving forward, and that still exists. Our primary objective is to put money into companies that we find are highly strategic to Boston Scientific, leverage our abilities across our organization to help support those companies develop and advance to a point where they may be ready for acquisition.
Great. So David and Sean, can you guys talk a little bit about why your health systems got into venture? I know it's been going on for a lot longer, but so what were your reasons for getting in, and how have you sort of felt your relationship with innovation and early stage companies change?
I can start. So Sean Cheng, great to meet everyone. I'm a managing director at Ascension Ventures. We've been around for 20 years, and so I wasn't there when I got started, but if I were to channel the executives at the time, including Doug French, who eventually founded Santé, they were thinking about it, obviously from an innovation point of view of pushing the U.S. healthcare forwards, but also I think there was a financial element to this. I've been with Ascension for about a year. So prior to that, I was with Philips on the corporate side. And what I didn't realize is the returns for these nonprofit organizations really go back to fund the operating side, right? And so in a landscape where right now 70% of the U.S. health systems are in the red and losing money, it becomes ever more important where those checks that we get back from the exits go straight to the clinicians, the nurses, the administrators, and operating the health systems. So those are really the main reasons, and we've been at it for 20 years to Fund 5 right now, and continue to do that moving forwards. So I'll hand over to David to kind of fill in the rest.
Yeah, thanks, Sean. Dave Kereiakes, thanks to the team at LSI for including me here. I'm humbled to be included on this panel. I'm a partner with Providence Ventures. Our parent is Providence St. Joseph Health, one of the largest nonprofit providers of healthcare in the country, based in Seattle, where I'm headquartered. And then we're the market leader in Seattle, Portland, and Los Angeles, Orange County. So hopefully none of you have to see us while you're in town today, but there's some good sites down the street. So we got into it now for 10 years. I've been with Providence Ventures 4 years. Providence has committed $300 million in the form of 2 growth equity vehicles, $150 million each, for the very reasons Sean laid out. And then I'll add, because Ascension was doing it, and health systems don't like to be the first, but after the path is laid, in order to stay competitive, get access to innovation and unique technologies, be viewed as an innovative leader, and then most importantly, drive investment returns. So finding new streams of revenue is a big, important part of what we do. Again, those investment returns, unfortunately, we've been able to provide quite a bit back to Providence, and so the lights will stay on a little bit longer, at least for our fund, go to fund the mission, which is caring for the poor and vulnerable, which is an increasingly negative margin, unfortunately. So that's the reason why we did it. It's been, we've got incredible support from the C-suite and a commitment to continuing it.
That's great. Well, a question for all of you. Obviously, you're looking for returns, but how do you balance things that line up with your strategy, move your goals forward for your hospital, for your company? How do you balance those things when you're looking at opportunities?
I'll maybe start. So for our fund, we're a $100 million fund with that financial focus, kind of first and foremost. We're going to be measured, and as a team, we're aligned around the financial success of the deals we do. A really clarifying and important factor for us as we navigate our startups, our co-investors, and get ourselves into deals and opportunities. The opportunity to when we're looking and trying to explore, our goal is advancing the ecosystem. Can we accelerate minimally invasive care? So we start there. We start with a strategic lens, and that's kind of the ocean with which we'll hunt for exciting deals. So we start with the strategic rationale, and we purposely cast that broad so that we can find best-in-class financial returns, a win-win within those. But we look at ecosystem, we understand where there are opportunities in digital, in therapeutics, in diagnostics, areas that early stage companies are going to transform the patient journeys that might touch on minimally invasive care. If we identify a thesis there, we justify that, and then we can go out and find the very best companies that have market leadership, that have best-in-class technology, the best teams, and satisfy that financial returns benchmark that we're striving to. And we'll only deploy capital when there is that win-win. And it means that that's a significant differentiator for us from our business development colleagues, because they may have a strategic thesis and be out looking for opportunities. They don't need to reach that financial bar to be able to engage with a company if there's a strategic rationale. And that's an important differentiator for us, because we will only deploy that capital when the finance has been reached.
And maybe to augment that from the health system side, we obviously have a closer link to the clinician. So the second call we make is, to the service line leader or the expert in that specific area. And we do these listening tours throughout the year. Fund 5 is representing 13 different health systems in addition to Ascension. So OSF, Advent, Ohio Health, Novant, to just name a few. They all have representatives as part of our investment committee. And so through those voices, they really drive, I would say, the health system zeitgeist for us to think about things. I think what's probably changed now more so is in talking to our purchasing groups like the resource group at Ascension, cost has become much more of a top of mind than before. I think when folks are making purchasing decisions as health systems before, it was a lot of KOLs that pound the table, and then you kind of get the latest and greatest widgets. And eventually somehow it works to kind of break even or a little bit of deficit or a profit. Now it's a major driver around, what is the price of this unit here, and is it, the best thing from a health economic point of view in addition to outcomes? That is probably, I would say, a step before value-based care, but certainly in that direction. That's driving a lot of our thinking. But I think returns, like my colleagues here, is table stakes. So we're still trying to drive that 20 to 40% IRR and money back into the investors. And so those are the things that are competing in our heads as we think about investments.
Yeah, I think it's a critical component to what we do and for the longevity of the fund, that if you're only strategic money, you're going to run out of it. If you're returns oriented and you view the world in that regard, you find the strategic value in a lot of these assets that we'll invest in and back. I came from I spent 7-8 years with another growth equity, a traditional institutional investment fund, which most of the team does, and I think that's an important feature to have. By being compensated and driven to maximize investment returns for the health system and being good stewards of the capital, you find the strategic assets that are harder to rip out of the health system, that stand on their own, that are and you have to be careful not to put your bias or influence on these decisions. And we've stood up a very robust conflict of interest policy. So the technology, device, software, or service is evaluated and stands entirely on the merits of its clinical and economic efficacy and what it can do for the health system. Then after that, I can go in and do an autopsy on a postmortem on the sales cycle, pull a lot of the unique understandings of that. So what budget did it come from? What cycle? Who's the champion? What did they compare it against? Why? What was the real value proposition, both from the sales side and from the supply chain, from the clinician, from the administrative team? Who had to say yes and who had to give approval, and how did they do it? Aligning all of those and getting a better sense of how that unfolds can really shorten the sales cycle and drive greater efficiency on the investment return as you go to other health systems. And having the credibility and access to peers within the system who made that decision on their own in a form as a KOL can really help accelerate growth. And we've seen that. So Providence has made 27 investments. They're a customer of all 27 of those businesses. And there's a really nice case study across all of them to show that kind of growth and the unique perspective.
Yeah, so again, lots of admiration for the additional complexity that you all have to bring to the to your decision-making criteria and having to look at it from both ways. I mean, because that does add some complexity. We look at our returns, but we look at our returns in hindsight, sort of more of a check to make sure we're being fiscally responsible. Are we exceeding our weighted average cost of capital? But it's a much, much more simplistic viewpoint from that. And again, it's purely strategic. It gives us a ton of flexibility and really aligns us well typically with management because the interests are completely aligned. The mutual goal is how do we make that company as successful as it can be, and we have a lot of flexibility both financially but also non-financially, functional expertise that we can bring to do that. And so that's really how we look at it.
I mean, I think that brings up a really great point of the functional expertise, the operational expertise that you can all bring to the table. Do your companies appreciate your ability to kind of bring that and help them figure out what they're doing, commercialize, et cetera? Like, what kind of advantage does that give them?
I hope so. They will continue to, I mean, I haven't completely lost touch of all the entrepreneurs. They still answer their phone. So I do think it is valuable, and I can point to some examples of where we were able to uncover something that was unique. So for one of the companies, a company called Boulder Surgical, which was formerly known as Just Right, we were investors in that, and in our supply chain, we saw that it was able to get through supply chain because of a unique label that it had that the other two big competitors who are dominant, massive med tech companies had blocked out everybody else. And because of that unique perspective, we were able then to say and build out the label such that we can get into, move from pediatric hospitals where it was a dominant player, but there's only one pediatric hospital in every city, and so the sales cycle and sales force can be expensive to build to make it applicable to the adult hospitals and get on contract with them. So it does make a difference. I would also say it's important to know who your strategic is and why they're advising you that way, and don't let it steer you entirely to only make decisions based on that, right? If you're designing something solely based off of the feedback that Providence is giving you, you're going to waste a lot of money. It's going to be a customized solution that works for a $28 billion integrated delivery network that it isn't representative of the rest of the market. And the same thing goes for the corporates too. You need to understand who you're designing something for, who you're building something for. Another example was at Varon Medical, where BTG was an investor. We often had to think, are we designing and investing in R&D so that it fits BTG's portfolio as an investor, or are we designing this for the market? And I think you are all here because, and we will all have long careers in the venture world because big companies need to find R&D elsewhere. So
I'd maybe just jump in to say, I think your point of where that advice is coming from, the quality of that advice is so critical, but the financial alignment, going back to the structure of a corporate venture fund, when Providence Ventures invests, it's you providing that advice. It's not Providence, right?
Yes.
It's you as a partner that wants to see that value creation, that success. And so you're able to translate maybe the Providence story and also highlight, hey, this is where that might differ from an Ascension, and this is where we've got it right as a corporation, and we manage through that ourselves when we're looking at a broad spectrum of areas. I mentioned diagnostics, therapeutics, digital. Every deal we do, we have to sell. The best companies, entrepreneurs that are taking a risk on a strategic investor, they need to know what value they're getting. It's not enough to be providing capital for any investor, let alone a strategic. And so, it's important as we've structured our team that as individuals, we will be out there batting for the next financing round for that introduction. I will introduce them to a competitor if that is independent value creation and it's an opportunity to do so. And then beyond the individual level, I have a unique access, as we all do here, to a set of resources. In our instance, that might be regulatory, reimbursement, commercial best practices for market development. It might be technical know-how, and we will curate, what that level of value add could be. But I wouldn't say it's just kind of table stakes. It's so critical for us to do our jobs well, I think, also, and hopefully add value to the ecosystem.
Yeah, I'd say this is a question that I approach with a great deal of humility because as a corporate investor since 2012, candidly, we as an organization, we've made every mistake as a corporate investor that you can make along the way, and we've tried to learn along the way. I think a lot of that is much about education of our internal corporate leadership, and as Dave was saying, appreciating the separation between what is the pure strategic interest here and what's going to be the best path forward for the company, but also how can we fit in this broader venture ecosystem in a way that works? Because just along strategic investors, there's a ton of differences. Now introduce financial investors now, and all the flavors that exist there, and all the different interests that gather around the boardroom table. So I hope we've done a good job of really growing to appreciate that, and hopefully making us a better partner in the broader ecosystem.
Let me ask you a touchy question. How do you feel when you see another strategic on the cap table? How does that influence your ability to invest? And when you're talking to entrepreneurs and they're asking your advice on that, what do you say?
I guess I can start, just having been on both the corporate side and now the health system side. I think at the corporate side, there's probably more anticipated stigma from the founders about having multiple strategics on the cap table than we felt at Philips at the time. Of course, it could have changed in the last 6 months, but I doubt it. I think the earlier stage companies, we feel that it's perfectly okay to have multiple corporates on there. If you look at the statistical probabilities of acquisition with how many names are on these line items on cap tables, it's very low. I venture to guess Philips has maybe less than 1% hit rate on those. And so I think it's more about learning, innovation, and helping push the field forwards as earlier you get. Of course, the later stage ones near acquisition, that's a little bit different story. And I've always said a row fence probably good enough, and you don't need a row for it to do anything on the acquisition side. Health system, I think, completely different perspective. What we probably struggle with is, if Intermountain's already on a cap table, what is the value add of an Ascension Ventures with them as an LP on it? And so sometimes there's probably a question of value accretion there, but we don't see that as a negative. It's just an additional customer, if not many more, right? So.
Yeah, for health systems, it's welcomed. I think you want as many as are interested within reason, because they turn over and they may not continue to be committed to it longer term. But you can get a better sense of market size and customer profile by having those investors along the table. On the corporate side, I think where historically we probably would have advised, and in my prior role as an institutional investor without any strategic ties, would have advised 2 is kind of what you need to have on your cap table. But since you have been in it for so long, attorneys have gotten very good at structuring and understanding where these risks are, that I don't see it as much of a problem, if at all, anymore. And even giving a ROFR based on what the attorneys will advise you, and you got to find a good one that's done it before. Putting a time limit on that can be helpful and there's different ways that you can structure it such that you don't have that kind of risk, and it's been done thousands of times already. So the risk of it to me is, as an institutional investor and as a customer strategic, I think is relatively small.
So it's a great question, very provocative. I think context is really important on this. First of all, if it is a situation where it's a last money in situation, short term, there may be some strategic rights attached to it, and that might make sense. The vast majority of our investments for at least the last 4 or 5 years are Series A, Series B, long runway to commercialization. We've tried it, trust me, and it just is really, really difficult. And we find less is more. So we don't tend to ask for any strong strategic rights when we're making particularly early stage investments. And we've invested in over 60 companies, and we've acquired 9 of those already. And we've had 9 others, though, exit. Thank you, Varen, to Olympus. Nice exit on that. And so we've felt like we've had a good hit rate without having to burden everybody, investors, management, with a bunch of complicated strategic rights that just become very difficult to really follow up on down the road.
I'll make a brief comment. I'm fully supportive of bringing the right parties to the table to support the companies, and I think it goes down to syndicate and balancing what the company's trying to achieve and what advice or strategic value they're trying to get. Our baseline is we want independent optionality and value creation for the companies that we invest in. So if there is a ROFR or there's some limitation on the optionality for the startup, we'll see that as a negative to their future financial success, and that will be a bearing in our decision whether or not we invest. We have used our kind of, quote unquote, founder-friendly mindset on that to actually negotiate with other strategics that are in a deal to unwind some terms where we felt that was limiting the future optionality. And I think that's important that there's an openness, because I do think in this day and age, and obviously it's a rapidly evolving day and age, in the current market, but good companies have options, and they should maintain that optionality for as long as possible. I'll give 2 brief examples where I think quantity can be powerful. We co-led a deal last year with J&J in a medical device cybersecurity company. I think that was a deal, and to your point about context, where we felt that actually our kind of position across the table in the field of surgery and robotics, working with an independent third party that will have an important role, we think, as an independent company to the medtech world, but as a customer, as medtech being customers to this player, was really exciting and really opportune. So a few, including Dexcom, who are here, venture group, investing in that, recognizing that there's an opportunity actually to do that. Another one of our portfolio companies called Flywheel, which is in the data and AI management space, they have investment from Intuitive. We're bringing a surgical video and AI management kind of angle. They have Novartis that are bringing a life sciences and pharma and digital pathology, Hewlett-Packard on the software and the distribution, different strategics bringing different components to a high quality syndicate. And so for me, it's got to be context specific, but we've got to think about the best interests of the companies we're investing in.
So what's your advice to companies that are looking for investment from strategics and health systems? What are the best practices? What should they be aware of? What should they watch out for?
Well, I think first you could tell from this conversation, find the right strategic that fits you and fits your needs, because there's great skill sets that I'm sure we all bring, and so it is more a matter of fit perhaps than, hey, there's a best practice out there, or do this definitely, or don't do that. I think I don't want to repeat what I've previously said, but best practices for us that we found through the years, less is more, minimal strategic rights, how really being engaged as a board observer or a board member, and help between financings as much as you are helping at financings. I think other, just standard information, liquidation preferences, trying to be middle of the fairway on each of those terms. But otherwise, again, it's all individual, and each deal is going to bring its own different challenges and opportunities to navigate.
I'd just say you want to build a good business first and foremost, and if you build something to be sold, it'll be sold. And you want to build a business to be bought, and to be bought at the opportune time where you're not shopping it or selling it. So if that means working with any one of us or any other capital provider, or even high net worths or angels, you want to build a business and do it in a way efficiently that can return as much to the shareholders as possible, and build that business to be bought.
I would just add, as entrepreneurs out here in the audience, and you're speaking to strategics, you hear the variation between, certainly on the corporate side, maybe less so on the sophistication that the healthcare system VCs bring. Do your own homework, do your diligence, right? Understand what is motivating this group, what is success for them, what is success for the platform, for the individual, what firewalls do they have in place, what information safeguards, what are the, what will behaviors at the individual and platform level look like in certain future scenarios. Have these conversations transparently with your investors to understand, to your point, Colin, what is this the right fit for where I'm at, what I'm trying to achieve, what my success as an entrepreneur looks like. And I think that is the great thing about the groups here. There's the transparency, and we've all optimized our structures to achieve the ends that we think are important. And I think it just is incumbent on entrepreneurs to understand that well up front, and to go into those conversations and negotiations open-minded.
Yeah, not much more to add besides I'd say, inform us. We're a very large organization, so if there's conversations already happening, with one of the health systems or hospitals or divisions of a corporate, then lead with that as part of the conversation. But also to David's point, if you build a good business, it shouldn't be relying on a single entity as a customer or benefactor. I think there's a lot of charity going on if that's the case, and probably quite a bit of supplier or customer risk as we assess businesses. So it's a healthy balance between those two things.
So as you guys move beyond being consumers and acquirers of technology, how do you feel like your relationship with innovation has changed and your contribution has changed to the ecosystem?
I'll go ahead and take first crack, I guess. So I think from our perspective, what has really helped is it's changed. If we came into this 10 years ago from a very transactional approach, we were accustomed to M&A, and M&A is a net sum zero game, so to speak. And what venture has taught us, what we've learned is, obviously, it's a totally different animal, and you can't bring an M&A approach to venture. And so I think that's first and foremost, is understanding that it is not a win-lose, zero-sum game. It's a relationship, and it doesn't end at the transaction and when the check cuts. In fact, it begins at that point. So I think those are probably the two biggest areas. And what we fully understand on the venture team, it may or may not, we may not be the right venture partner, but it also doesn't mean that we're not necessarily a good acquirer down the road. The two are completely separate conversations in our organization and our strategic approach.
Yeah, and Colin, to what you said, and the reason why you all got into this is the void of capital that was present at that time. And I think we're running into that as cycles come and go. And it was great having you in and the strategics in the market at that point in time to help the ecosystem continue to progress. With the health systems, I think we've matured to the point where we can start identifying the impact that we've had. So in the past 4 years that I've been at Providence, we've introduced over 400 companies to over 200 different stakeholders within our system across all 7 states and 7 regions. And we made 12 or 13 investments. So the kind of impact on innovation and flowing that into the health system, helping administrative leaders understand and sort through best-in-class technologies where they're being bombarded with kind of that next wave of how do I bring AI and ML into my practice? And this company is pitching me and saying that they can do all of that. And what companies are you seeing, and how can you help me understand this? Is a big role that we play. And so it really is, I think, influencing the way that care is being delivered in this country and having a material impact in alleviating the burden that's put upon the caregivers that are sacrificing so much to deliver care, and allowing them to really just get back to practicing and have innovation come to them in a way.
I would say the role that Intuitive Ventures played, and I'm not on the BD side, so we're very much separate, but we get to be a front door for Intuitive. We're a venture fund first and foremost in how we operate and how we deploy capital, but we are a front door, and we're connecting, similarly to David's point, hundreds and hundreds of companies every year, and we're can be a trusted partner to those startups to navigate who and when and why you might engage with Intuitive proper at the right time to facilitate a pilot or a collaboration or a commercial or a licensing or an acquisition or whatever that might look like. And we found ourselves as being a helpful conduit, not just for Intuitive, but for the ecosystem to kind of navigate Intuitive as it bolsters its position in that field. And I think for Intuitive, we've become a partner in thinking through kind of what are those trends, those important areas. We're also thesis driven, so we get to go out and hunt and look for those exciting best-in-class startups in areas that traditionally haven't been part of the Intuitive roadmap. And that's, again, why I go back to this broad thesis in life sciences. We've invested in biotech. We're looking at diagnostics from liquid biopsy to other areas. And hopefully for the startups, get to translate why that's important, why that's relevant, why Intuitive as a surgical device company might have a role in these types of areas going forward. So for me, that's the role of a venture arm can be value added there.
Yeah, and I'd say for us, over the last 20 years, there's probably been a crawl, walk, and then now a run type of model, and sort of Ascension Ventures 3.0, where we'd like to get more integrated into the LPs and their vast networks, 460 acute care facilities, and not only help our portfolio companies, but any early stage companies in accessing these clinicians. And together create impact in the 5 to 10 year time frame to really change U.S. healthcare. In practice, we're also starting to have more communications with our purchasing groups and other operational sides of things where, again, the cost side is becoming more important in understanding what are the top cost items and buckets where we can actually inject innovation and in a free market way promote competition to drive down some of that pricing and increase the outcomes. And so we're getting our ducks in a row here and to try to play chess at that level too. That's certainly why I'm excited about this and get up every day and to do it. So really excited for the next phase.
Great. Well, we're almost at time, so thank you guys so much for your thoughts and sharing with our group here how you're feeling about corporate venture and healthcare system venture. So thank you.
Thank you.
Thanks very much, everyone.